Welcome to vTalkInsight, Market Drivers Daily for April 13th, 2026. The United States is moving toward a naval blockade around Iran. Oil is back above $100, yet global equities are only modestly softer. Today we unpack whether markets are underestimating the shock from the Strait of Hormuz, how that is feeding into supply chains, and what the new volatility regime means as bank earnings kick off. Geopolitics is back as the dominant macro driver, with the U.S. preparing a naval blockade aimed at Iranian ports and shipping around the Strait of Hormuz. The operation targets Iranian oil flows of roughly 2 million barrels per day for now, but the tail risk is a much broader disruption that could hit a large share of Gulf exports. Oil has responded quickly. Brent and West Texas Intermediate have jumped 7 to 8%. Pushing back above $100 per barrel, and front-month futures are trading sharply higher on blockade headlines. Under the surface, the stress is even more acute in physical markets than in futures. Spot cargoes in parts of Asia and Europe are reportedly clearing at $140 or more, while more than 200 tankers are effectively trapped in the Gulf and a backlog of ships remains unresolved. Estimates suggest that around 13% of global oil and 20% of gas supply have been disrupted for several weeks. Yet long-dated futures and broader risk assets still price this as temporary rather than structural. The macro implications point toward a stagflationary squeeze if the disruption persists. Oil near $100 is already feeding into diesel and gasoline, lifting transport and logistics costs and threatening to drag down real consumption, with early signs of demand pressure in lower-income U.S. households and parts of Asia. Central banks are caught on the wrong side of this move. They face a supply-driven shock that interest rates cannot fix, but higher energy is pushing inflation expectations up, delaying any rate cuts, and even reviving talk of an insurance hike if core measures fail to ease. At the same time, the crisis is reshaping relative winners and losers. The U.S. is emerging as a net beneficiary from disrupted Gulf flows, exporting more crude and liquefied natural gas, and gaining pricing power as Asian buyers scramble for alternatives. Europe looks more exposed. It still relies heavily on imported fossil fuels and faces rising diesel import dependence, while political shifts such as Hungary moving toward a more pro-European stance could unlock large aid packages for Ukraine and reinforce the bloc's focus on defense and energy security. Despite this backdrop, equity and credit markets remain remarkably resilient. The S&P 500 is only modestly off its highs. European indices are down, but far from capitulation, and credit spreads stay tight, even though oil has more than doubled and energy sector stocks are rallying strongly. That resilience rests on an optimistic base case. Many participants assume the blockade will stay targeted at Iranian exports, that Gulf producers can reroute supply, and that diplomacy will eventually limit escalation, keeping any oil spike short-lived. The risk is that this proves wrong. If enforcement becomes broader, if Iran follows through on threats against Gulf ports, or if China is drawn in overcargoes headed to its refineries, markets may have to reprice quickly towards scenarios with $140 to $150 oil and weaker global growth. In summary, geopolitical risk premia are fully embedded in energy, but only partially reflected in risk assets. The key watch points now are how the blockade is implemented, any Iranian retaliation, upcoming OPEC and IEA reports, and CEO guidance this earnings season on energy costs and demand. Those geopolitical and energy dynamics are already feeding directly into global supply chains, where the pressure is building beyond just headline oil prices. The Strait of Hormuz story is no longer just about higher prices. It is about physical availability. Weeks of disrupted flows mean that a significant share of global oil and gas supply has been offline, and the closure has left more than 200 ships stranded, with insurers reluctant to cover transit through the choke point. Crude freight rates from the Middle East to Asia have exploded to around $18 per barrel, over 1,000% above pre-war levels, turning logistics into a major driver of landed energy costs. The immediate stress is most visible in transport and travel. European airports have begun rationing jet fuel as product shortages spread from Asia, and airlines are reacting with route cuts, surcharges, and higher ancillary fees to offset rising fuel bills. Travel and airline stocks are under pressure globally, with some European carriers hit by a double shock of higher fuel and labor disruptions, such as the multi-day pilot strike at Lufthansa that is canceling hundreds of flights and disrupting cargo operations. Beyond aviation, the squeeze is rippling through manufacturing and agriculture. Japanese manufacturer Toto has halted new orders for prefabricated bathrooms due to material shortages linked to the Iran conflict, highlighting how petrochemical and refined product flows from the Gulf underpin Asian supply chains. Fertilizer exports from the region, which account for up to 30% of global supply, are also disrupted. The United Nations now warns that higher energy and fertilizer costs could push tens of millions in developing countries into poverty by undermining food systems. Governments are starting to respond, but with limited room for maneuver. European fossil fuel import costs have already jumped by more than €20 billion, sparking debates over fuel tax cuts and support packages. Ireland, for example, has rolled out a €250 million relief plan and reduced excise duties on petrol and diesel, while other countries with weaker balance sheets have far less fiscal space, underscoring growing divergence inside Europe. Financial markets, however, still seem to assume that these disruptions will ease within a month or two. Futures curves remain below the extreme levels implied by spot shortages, and broader indices have not fully priced in the risk of more lasting damage to energy and goods supply chains. The key risks are that shipping lanes stay impaired, fertilizer flows remain constrained into the planting season, and Asian and European factories face extended shutdowns. In that scenario, the current supply shock could evolve into a more persistent drag on earnings and growth. As this tension between physical scarcity and market optimism widens, it is also reshaping the volatility landscape across commodities, equities, and credit. Volatility has spiked, most visibly in energy, while staying comparatively muted across broader equities and credit. Brent and U.S. crude have seen intraday moves of 7 to 8% on blockade headlines, and the gap between physical prices near $140 and futures near 100 underscores the uncertainty around duration and enforcement. Options on oil and energy equities have repriced higher, and spot natural gas in Europe has also jumped, yet implied volatility on major equity indices remains contained versus past geopolitical shocks. This pattern is feeding directly into the financial sector as earnings season begins. Trading-heavy banks such as Goldman Sachs, Morgan Stanley, and J.P. Morgan are positioned to benefit from elevated market swings, with expectations of roughly $18 billion in equity trading revenue across major lenders this quarter. Early results highlight the split. Strong equity trading and deal activity in areas like energy, security, and AI are being partially offset by weaker fixed income revenues and concerns over private credit exposures, leaving share price reactions mixed and sensitive to guidance. Geopolitics is also a growing source of policy and country-specific volatility. In Hungary, the decisive defeat of Viktor Orbán and the rise of a more pro-European government opened the door to unlocking around €90 billion of aid for Ukraine, but uncertainty over control of key domestic assets keeps local risk premia elevated. In the U.S., multiple expulsion votes in Congress add to political noise, while tensions with Iran and the prospect of trade measures, such as steep tariffs on Chinese goods, keep the policy outlook fluid and hard to price. Despite these shocks, positioning still looks more complacent than distressed. The S&P 500 has only seen a single-digit pullback even as oil has doubled. Small-cap valuations remain above past recession troughs, and credit spreads are historically tight given the backdrop of war, higher energy, and fading hopes for rapid rate cuts. Markets are increasingly focused on binary outcomes. A breakdown of the ceasefire or an expanded Hormuz blockade could trigger a 2 to 3% equity sell-off in short order, while a credible diplomatic deal on Iran could propel indices to new highs. For now, volatility is creating both risks and opportunities rather than an outright crisis. Trading businesses, energy producers, and parts of the defense and cybersecurity complex are seeing stronger activity, while travel, airlines, and some rate-sensitive sectors face mounting pressure. The next catalyst for the volatility regime will be the flow of bank earnings and CEO guidance on energy costs, any change in Hormuz shipping conditions, and whether current credit tightness finally starts to loosen. How markets navigate that mix will determine if the recent spikes stay localized or broaden into a more sustained repricing across asset classes. Taken together, the message from today's tape is that geopolitics is adding a structural layer of risk. Energy is the main transmission channel, and volatility is no longer confined to commodities alone. To wrap up, the planned U.S. blockade around Iran has pushed oil back above $100 and tightened physical supply, but equities and credit still look relatively calm, leaving a gap between geopolitical risk and market pricing. Supply chains from aviation fuel to fertilizers are feeling the strain, which could feed into Q2 earnings, inflation, and growth if disruptions persist. Volatility is elevated in energy and selected sectors, while index-level moves remain contained as bank earnings, policy headlines, and Middle East negotiations drive a more binary risk backdrop. Keeping an eye on Hormuz shipping flows, upcoming OPEC and IEA reports, and CEO commentary on input costs will be critical for interpreting the next leg. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.